Hello, welcome. Thanks so much for joining us for this, the fifth in the ByteTree series of Bitcoin and gold in 2022, where today we're just going to be talking about Bitcoin. A bit of housekeeping first. Firstly, this is not investment advice. Please contact your financial advisor if you want some financial advice, but you're not going to get it from us. Secondly, this is being recorded, so if you miss anything or want to go back, please go and have a look. It'll be on our the ByteTree YouTube site. And thirdly, please put your questions and answers in, and we will try and tackle those as we go along. Great, so let's get on with it. So today, as I say, we're going to be focusing just on Bitcoin, which is by some distance the largest crypto asset with a market value of about 560 billion US dollars, depending on how you calculate it, which is approximately 45% of the value of all crypto assets. And I hope today that we can just provide a solid grounding for people who are coming to it early, who want to understand a bit more about what Bitcoin is all about. So there are a few reasons why we're going to do this. Firstly, my belief is that there are a lot of people who buy Bitcoin for the wrong reasons, just for a bit of a punt. In my experience, if you buy for the wrong reasons, you'll probably sell for the wrong reasons, and we want to help people avoid do that. Secondly, it's an asset class that I think we can be very certain now is not going to go away. So you might as well find out a bit more. While there's a lot of negative press around, and obviously prices have been volatile, there is a huge amount of investment going in from some of the top private equity companies in the world, and it's an industry attracting some of the brightest young developers on the planet. And thirdly, we are going to try and address some of the concerns. There are a lot of concerns out there that people who talk to me almost always start with when they're asking about it, and we'd like to sort of tackle those. And to help me do that today, I am utterly thrilled that we've got Eliézer Ndinga, who's the head of research for 21Shares. Eliézer, great to have you here. Thank you so much for joining us.
Hi, Charlie. Thank you for having me. It's a pleasure to be here.
It's a huge pleasure. Will you just tell us a little bit about yourself and about 21Shares?
Sure. So I'll start with 21Shares. 21Shares, we are the largest crypto ETP, so exchange traded products in the world. We have 30 plus ETPs listed on prestigious European stock exchanges. And I'm leading the research team. We're a team of 7. We have data scientists, smart contract developers, and former consultants. We're looking into the entire asset class from DeFi, payment networks, metaverse, NFTs, macroeconomics, and regulations. And we have different type of content that we put out there in order to, number one, educate the community, but most importantly, to launch these products as fast as possible, and most importantly, being first on the market. So we have different hats in the research team. We're cross-functional. This is really exciting to really understand this asset class inside out with our different set of researchers. And as far as my background is concerned, before 21Shares, I was a venture capitalist in New York City. I was investing in fintech and crypto companies. But my journey in the crypto asset industry started back in 2014 through a computer science and cryptography course by a former Navy SEAL who actually discovered Bitcoin by serving in Afghanistan. And he went on to teach about Bitcoin through this very unrelated course about cryptography and Bitcoin for business students. And I was one of them. And yeah, it's been quite a ride over the past 8 years to really witness the growth of this asset class over time.
Yeah. In 8 years, you're a veteran in this space, and I can certainly say, because we've worked very closely, of course, with you guys at 21Shares. You have a fantastic team of some really smart people, and you're doing a really terrific, terrific job. Right. So let's get going with Bitcoin, because and let's start at the very beginning, because I get a sense that a lot of people think this thing just appeared out of thin air. It's been going for 12 years. but the story of where it came from is extremely interesting, and I think extremely important, and goes back really 40, 50 years, doesn't it? Could you tell us a little bit more about the history and the sort of the philosophical underpinning of Bitcoin and where it all came from?
Sure, and this is a fantastic question. I agree. Many people think that Bitcoin started back in 2008 with a white paper, actually during the Halloween day. But actually, when we look into the set of technologies that made Bitcoin today, comes back to the late 1970s. And every time that the main technologies that are super important for Bitcoin today came onto the market was amidst public distrust. And back in the 1970s, exactly in 1977, we had the Watergate scandal. Obviously, done by the former president of the US, Richard Nixon, trying to spy on the Democratic Party. And at that time, public key cryptography came onto the market, so was invented in order to make sure that private messages could be transferred on open channels. And even back to during the World War II, what happened is that most of the messages today at that time were actually transferred and exchanged in private channels, because in public channels there were no other way to make them transferred in a private manner. So public key cryptography came onto the market to make sure that we can transfer encrypted messages in open channels. And that's exactly what is used today for Bitcoin in order to send and sign a transaction. This is with a public key cryptography. And this is impossible to basically reverse and decrypt the information unless they have a secret code. And the secret code in Bitcoin is called a private key. And that's really the innovation here, that only the person that has a private key can decrypt the message and obviously sign the message to send it over to someone else's. And that's why with obviously the transfer of texts and letters. But obviously with Bitcoin, that came about for exactly launching a worldwide monetary system that is not controlled by any government or corporation. But even before the launch of Bitcoin, fast forward from the 1970s to the early 1990s, the internet came about. And the internet came about at the same time as the cypherpunk movement. And the cypherpunk movement back in 1993 really had a focus point on privacy. They wanted to make sure that if we have today an open communication to communicate with one another on a global scale, we want to make sure that there is no mass surveillance on the individuals. So the cypherpunk movement was made of a dozen cryptographers around the world, some of them actually suspicious to be potentially Satoshi Nakamoto or a group of them. But no one obviously knows today the full identity of the founder or the founders behind Bitcoin. And obviously the cypherpunk movement really shaped the innovation behind Bitcoin fast forward to 2008. But again, what happened in the 1990s was amidst public distrust. In the mid-1990s, what happened is that there was obviously the collapse of the Berlin Wall in 1989. And then came about the web, came about the cypherpunk movement. And then in 2008, obviously, as we know, the great financial crisis, and why Bitcoin was invented to make sure that there is an alternative for people to invest in alternative commodity or having access to an alternative global payment network.
Yeah, so you've got sort of 40 or 50 years of R&D going to this, backed by two philosophical strands. One is the need for greater secrecy, which is born of kind of government distrust, and the other is to try and find some sort of new form of money that again bypasses centralized governments. So the next question is, I suppose, what were the experiments that failed, and why did Bitcoin succeed? And perhaps you could touch on a bit of what Bitcoin actually is, without getting too technical. Because I know a lot of people look at it and go, well, it's just a series of numbers, and it's a sort of, and I know that's confusing because we all had to confront it at some stage.
Absolutely. So I think we need to understand first the monetary policy of Bitcoin. Bitcoin has a very strict monetary policy that is limited and decreases every 4 years. And this is programmatic. So essentially, this is impossible for anyone to mint or create new Bitcoins the same way we printed more dollars for sustaining the crisis with the COVID-19 pandemic. So Bitcoin has a limited supply of 21 million. And this is decreasing over time every 4 years. And it has a currency in order to align the various payment providers or payment processors in the network. It's not just one bank, it's not just one payment provider, it's not just one entity, it's multiples called miners that verify the set of transactions. And the set of transactions are verified to make sure that no one can replicate the Bitcoins that they have in their wallet to another person. So if you send me one Bitcoin today, I cannot replicate that transaction to another person. So that's basically making sure that this is a counterfeit resistant payment network in the internet age. So there is no replica to that. That's number one. And number two is a limited supply, which means that there is a scarcity attached to it. And why? Because Bitcoin is very akin to gold. So if people want to think about the main use case of Bitcoin today, Bitcoin is very similar to gold with a limited supply and a hard supply. But this supply is verifiable and actually accessible 24/7 on the internet. And there is a ledger. The ledger is called the blockchain, and investors were able to verify the set of transactions since the genesis. So since January 3rd, 2009. And that's a very powerful concept because transparency is very important. And that's what makes Bitcoin very valuable today, especially when people want to believe in the system and making sure that they understand where the flow of funds goes to one entity to another. But in a nutshell, if people want to understand what is Bitcoin, essentially Bitcoin is a internet native digital commodity. It's accessible on the internet 24/7. It's a decentralized network as well. There is today millions of miners available on the network to verify the set of transactions. And they're using supercomputers to essentially verify the transactions and secure the network as fast as possible. So every 10 minutes, essentially the transactions get settled on the Bitcoin network. Why 10 minutes? Essentially because the creators or the creator of Bitcoin wants to make sure that there is a latency to keep decentralization. If it goes very fast, it means that the fastest computer, so just one or two, would be able to verify and get rewarded for providing the security of the network. So to keep the decentralization at 10 minutes was very important to be adjusted here.
Yeah.
And this is a very powerful concept.
Yeah, there's a huge amount you've just mentioned and a huge amount to unpack there, and perhaps we'll come back to some of it later. But what we've got here is essentially what the internet and cryptography gives us for the first time is this notion of digital scarcity. Mm-hmm. Isn't that right? So in the past, and anything to do with software, you can copy and paste.
That's right.
And this new technology gives us for the first time the ability to own stuff in the internet world. And I think secondly, from what you've been saying, we have a form of money, and we'll discuss kind of how we should think about it, that cannot be debased. Mm-hmm. So this is the battle that we're all facing at the moment as we confront inflation, is that this, depending on who you speak to, but there's a very wide consensus that inflation is caused by money printing or money creation, excess money creation over time. So here we have a form of money similar to gold in that regard, that cannot be debased. So let's think about that. Its identity. I think a lot of people sort of look at it and go, it's digital gold. Is that the right way to think about it, or is there more to it than that?
I think this is the right analogy, but this is not a timely analogy. Bitcoin is an emerging store of value. It went from actually zero to close to $1 trillion in the span of like 12 years. So of course that goes along with volatility and a lot higher volatility levels than any other asset classes. But the best way to describe Bitcoin today is, number one, for its main use case, it's an alternative and emerging store of value, but it's also a censorship-resistant payment network where people have the opportunity to use this as an alternative to distrust in their governments or in times of crises and war. And this is exactly what we see, especially what we saw over the past couple of months in Ukraine, people leaving the country with a simple USB key that contained their savings, but denominated in Bitcoins, not in other fiat currencies. And that's a very powerful concept here. And it has two faces, as you can see. Bitcoin is both like an emerging store of value, but also an alternative payment network native to the internet.
Yeah, I think that's one of the most fascinating things about it, isn't it? Is this incredible versatility. On the one hand, it's, people like to describe it as digital gold, but at the same time, if you look at the original white paper, it's a peer-to-peer form of cash. It's like holding a pound note or a dollar or whatever in your hand and giving it to someone. There's no one in between. And you're right, and we'll come on to the people for who it's used to. How then has there were lots of different ideas. If we go back to the sort of earlier days of crypto, there were loads of different cryptocurrencies emerging, but as I said at the start, Bitcoin is now very much the dominant beast. Why has it succeeded where others haven't?
And that's a fascinating question, and we don't want to give more complexity to that conversation. But Bitcoin is also a software, right? It's an open source software, and it has a set of developers and cryptographers that make sure that the network is also secure and that there is no vulnerabilities, which means that essentially the software itself could be copied. It doesn't mean that the coin, so the currency Bitcoin, could be duplicated above the 21 million mark, but it means that the software that makes Bitcoin possible to be accessed on the internet could be copied and pasted. It's called a fork. And there were many copies of Bitcoin over the past 12 years, especially in 2016 to 2017, where there was basically two movements in the Bitcoin community. One that actually wanted to keep decentralization and the processing of transactions very slow, so 10 minutes. And another one that wanted to have a higher capacity for Bitcoin. So processing transactions a lot faster than what we could see right now. And that basically came about with the rise of Bitcoin Cash. So essentially a faster network of Bitcoin. But all the copies of Bitcoin never had the opportunity to outpace the transaction or the network effects that Bitcoin was able to gather over the past 12 years. And network effect is an important component of these blockchains, because blockchains are accessible to everyone, and they have a community. They have a community of vendors like crypto exchanges, custodians, liquidity providers, market makers, ETP providers as well. And that network effect and liquidity is very hard to replicate. And that's why when we see, for example, Bitcoin Cash claiming to be a better version of Bitcoin, today is 0.5% of the value of Bitcoin, just $3 billion compared to what Bitcoin is traded for. And that basically speaks volume of the fact that there is nothing like Bitcoin, especially for the use case of store value, because as we know, a currency serves three main functions. There is a medium of exchange, unit of account, and then store value. But for the use case of store value and censorship-resistant payments, we've seen that Bitcoin has obviously given a lot more possibilities and liquidity for the people in need compared to its copies.
Yeah, yeah, I think that's exactly right. And that's the way we think about Bitcoin and try and measure its value at ByteTree. But of course, the other point to make is that having won the war, it's massively de-risked as an asset. I think we could have said, 5 years ago, maybe it's going to go to zero or disappear, but you can't say that anymore. And that is very much because of the network effect. I just want to come back because someone's made a very good point in the questions. Has Bitcoin a third-party liability? It's a great point, because unlike financial assets, shares or bonds or whatever, they are someone else's liability. And Bitcoin is not someone else's liability, rather like gold. So I think that's a great point, and one to be aware of.
No, it's a fantastic question for sure. And I think to some extent it has liability when relying on mining ships manufacturers, when relying on mining farms and miners as well. And as we've seen, Bitcoin is decentralized, doesn't rely on just one third party, which means that obviously there is an outage or there is a natural disaster and one miner goes down, the network keeps going. And we've seen that last year when the China ban happens, and China represented close to 50-60% of the mining market share, but the network was able to continue processing transactions slower than expected, because obviously it was a huge chunk of the market share shutting down. But we've seen that the network has come about to be stronger in terms of security by hash rate. So this is a measure of computing power in the Bitcoin network. And this is a really powerful concept, that despite the fact that yes, there is a third-party liability to some extent, this is a decentralized liability, which means that if one country shuts down, as we've seen with China, the network keeps struggling along. And that's a very important, I think, nuance to take into consideration.
Yeah. And actually that plays straight into something I was going to mention, which is this idea of anti-fragility.
Yep.
I think it's a Nassim Taleb concept. And in simple language, it's what doesn't kill you makes you stronger. And Bitcoin has been through this multiple times, and everyone's familiar with the blow-ups in the crypto world. It is a giant laboratory. But the point is that it learns and gets stronger and remedies the problems as it goes along, which has been a fantastic, fascinating part of that journey. We've talked quite a bit, Ellie, about the miners. Again, this is a sort of curious part of the equation for a lot of people sitting from the outside. Who are these strange people, and why do they have to use so much energy? And is that important? I mean, and can't they do it some other way? Can you talk very generally about the point of the use of energy and the consensus mechanism? And when we talk about consensus mechanisms, what we're saying is for everyone who's part of the network to reach a consensus on why it has value in a sense. And the sort of traditional world equivalent is say the US dollar, which the consensus mechanism is the rule of law, although some people say it's the rule of force. That's being very cynical, of course. So talk us through the miners. Why all this energy? Will it ever change?
This is a fascinating question. So I'm going to talk first about why mining exists today. And this is very important to note that Bitcoin mining exists for three main things. Number one, to verify the transactions on the network every 10 minutes. Number two, to settle the transactions on the network. Once we know that there is transparency and that the coins were not stolen. And number three, Bitcoin mining serves for security. So it's verification, settlement, and security. And this is a very important concept to secure Bitcoin as a non-state monetary system. This is the first time since 2008 that we have actually a monetary system that is decoupled from the government. And this is what Bitcoin provides. So its security is very important. And the security comes from supercomputers. And of course, they're using a sustainable amount of energy to do so. And they're using specialized machines called ASICs that obviously are way faster than our computer that we use today for this Zoom call. And this is important that they use energy today. But the most important point when we look into the energy consumption of Bitcoin is the energy source and the energy mix of these miners. If the mining activity is carbon neutral, this is where we know that this is actually a very efficient process and that does not impact our planet. And looking into the energy mix of Bitcoin, back in China, and I remember back in 2020, there were a lot of miners that talked to us at 21Shares that were mining Bitcoin in Sichuan. Sichuan was the hydroelectricity center to mine Bitcoin. So obviously a carbon neutral activity that does not impact global warming. And they were actually at that time moving facilities away to Kazakhstan and to a lesser extent in the US to mine Bitcoin with natural gas. Why? Because they were afraid of a potential regulatory clampdown that actually happened fast forward to a year later in May 2021. So what I'm saying is that looking into the energy consumption of Bitcoin, what is very important today is to understand what kind of energy assets the miners are using. And today, close to 40% of the Bitcoin mining market share comes from the US. So fast forward to 2 years later, we actually were right at 21Shares. The US is the largest market, and miners are actually were able to find home in the US. But we also see a lot of miners based in Sweden and Norway, and they're using actually hydroelectricity, and also in Canada they're using geothermal and natural gas. So the transition to sustainable energy assets is very important. The only thing that is missing today in crypto, and I'm going to be very frank with you, is a transparent and 24/7 available dashboard on the energy assets used by the miners. This is exactly what's missing. This is hard to find. The University of Cambridge does a great job at trying to understand the energy mix and also the Bitcoin mining map. But obviously, this is a growing process going forward. And there are two things that I want to mention about Bitcoin mining. So Bitcoin mining serves for the verification and settlement of the transactions and the security of the network again, but there is also the Bitcoin protocol. And the Bitcoin protocol are basically the set of rules in the network that is not associated with the mining process. These are the rules where this is impossible for you to receive more Bitcoins that you're supposed to be receiving. This is impossible to send more Bitcoins that you have in your wallet. And most importantly, this is impossible to receive more Bitcoins as a miner if you are able and eligible to verify the set of transactions. So today there is close to 6.25 Bitcoins that are created every 10 minutes as a reward for the miners. And this is impossible to receive more than that. The only thing that they receive in addition to the 6.25 Bitcoins are the transaction fees. So in a nutshell, there is a Bitcoin protocol to make sure that the scarcity is actually met and never get exceeded in 2040, so in a few 100 years. And then on the other side, there is Bitcoin mining for securing the network, verifying the transactions, and obviously settling them going forward. And that's very important to understand whether the miners are using fossil fuel or renewable assets. And we see actually right now, but based on empirical data at 21Shares, that a lot of miners are actually using more and more renewable energy assets. And actually there is a Telegram chat with close to 500 miners around the world dedicated for that transition. And this is really a growing group as well. So very fascinating.
Yeah. So really, unapologetically, the Bitcoin network, through the proof of work consensus mechanism, will use a lot of energy, and it will carry on using a lot of energy because it's utterly central to the security and the sort of processing of the system. The key is the type of energy, as you say, and that has been changing at a remarkable pace, particularly over the last year since the Chinese exited. And there's plenty of research out there which goes into more detail about that.
That's right.
So, Ellie, who owns Bitcoin, and why would you own it?
This is really interesting. So, what kind of proxy should we use to measure the ownership of Bitcoin? Should we use ETF issuers or private placements to understand that close to 70% of maybe family offices, maybe to a lesser extent, private banks own Bitcoin in Europe? But then we also have retail investors, and historically the crypto industry has been retail dominant, retail driven. Only over the past couple of years, we've seen the early innings of the institutional engagement and adoption of Bitcoin, especially starting with Paul Tudor Jones, a legendary hedge fund manager in the US, who actually invested in Bitcoin close to 2% of his net worth in order to anticipate the rise of inflation levels, especially in the first wave of COVID-19. And at that time, it was really a strong investment case because the borders were closed. And they understood that a digital native, internet native commodity would make a lot of sense. And then after that announcement, we've seen that university endowments like Yale University and Harvard University, MassMutual, an insurance giant in the US, and to a lesser extent some pension funds as well, started to actually invest in this asset class. We've seen also large companies like Square and MicroStrategy and Tesla. So I would say the crypto industry is retail driven, but over the past couple of years, we've seen larger checks in this asset class, especially with a strong investment case for Bitcoin and then Web3 down the line with Ethereum and its competitors. But sticking to Bitcoin, when we look into the traded volume on Coinbase, for example, which is one of the largest crypto exchanges in the world, they have a lot more traded volume from institutional investors than retail investors in terms of traded volume. And that's a really powerful proxy here to look into, which shows that there is a lot more engagement, and not just from maybe family offices or private banks, but also we also witness market makers and governments as well adopting the asset class as a legal tender, as we've seen in El Salvador. And that's really fascinating. And then there is a more overlooked use cases where people actually invest in Bitcoin or use Bitcoin in times of crisis, like in Lebanon, in Venezuela, but also in Ukraine, as recent as what we see right now with the unfortunate war. So that's really the overall landscape here. I think it's a lot easier to measure the institutional adoption through all of these institutional grade products available mainly in Europe, for example. But as far as the retail are concerned, looking into the web visitors of wallet providers and crypto exchanges, we see that a lot of retail investors come from emerging nations, and that's really fascinating.
Yeah. And actually, you started off with institutional investors, and we've got another great sort of point here. And it's something that's interests me a lot, is this sort of contradiction between this idea of a kind of free, uncorruptible, nationless form of transfer of value, and I was going to come on to it later, and regulation, but we'll come on to it now. And this idea that if something wants to be free, is it incompatible with it being regulated as well, or is it? Or does it have this sort of enormous flexibility as a form of money, where it doesn't really matter? It still works whether you're in a failing economy or economy with a failing currency. as much as it does in a family office in Geneva?
We're not dropping names here. But what I'm saying, I think this is a fascinating question because there are two things. There is a regulation of the businesses built on top of Bitcoin, and then there is a regulation of the Bitcoin protocol. And the best analogy to understand what Bitcoin is as a software, this is very similar to TCP/IP that makes our intercommunication over the internet possible. And Bitcoin, the Bitcoin protocol makes the inter-exchange of value possible over the internet. And in order to basically shut down or regulate Bitcoin, this would be as hard as trying to regulate the internet. But what we see as far as the regulatory engagement happens across the board, especially, for example, in China, that just completely banned Bitcoin, they are going after the service providers built on top of the Bitcoin protocol, whether these are like miners, exchange providers, vendors, and custodians. Because they have to basically comply with the local jurisdiction in order to operate, whether it's in China, whether it's in the US. And for example, in the US, any exchange that transfers more than $1,000 on a daily basis needs to hold the money transmitter license. If you want to apply for a bank charter, you need to go through that process as well. So that's why, as far as the regulation is concerned, the only way to regulate Bitcoin would be to regulate the companies and financial institutions building on top and making sure that they comply with the local jurisdictions where their customers are available.
Yeah, exactly. So you can regulate the institutions around Bitcoin, but you can't regulate Bitcoin, is the point, isn't it? It'll find a way. I mean, it'll change, the dynamics about who can and who can't buy it, and that might have a short-term impact. But it's very unlikely. I think there'll be a global body that just is capable of buying, but for all the reasons that you've just said.
For sure, and Bitcoin is only accessible through the internet. So if a government would want to shut down access to Bitcoin, they would need to shut down the grid in order to make sure that they don't have access to the internet or access to, for example, Starlink, the satellite connection launched by Elon Musk. So I think this is really interesting that in many places, even in India, Nigeria, and even in Japan recently, they were actually trying to embrace this asset class by understanding how to protect investors at the same time opening the gates for open innovation. And this is the same in the UK as well. They're looking for a good balance for a regulatory approach as well. And I think this is the best way to embrace a new technology, because when we look into the innovation behind blockchain technology in general, first with Bitcoin, for us, this is very similar to what came about in the early 90s with the web. And the best way to embrace that is to make sure that there is a really good regulatory framework for the businesses building on top that protects investors, that prevents money laundering and over illicit use cases.
Superb. Right, here's another one of my favorites. Isn't Bitcoin and crypto, isn't it really just for criminal usage and for money laundering purposes?
I think like crypto over the past 10 years has had a bad reputation with some of these mostly covered use cases that today represent less than 0.25% of the economic activity happening on the Bitcoin network. And there is deep and strong forensic research by firms like Chainalysis and Elliptic that look into the blockchain technology and look into the flow of funds and the wallet addresses, identify the addresses associated with terrorism and over illegal and illicit use cases. And I think understanding that crypto actually is used more so as a digital commodity from an investment perspective, and as a payment network for the people in need is very powerful. And the fact that illicit use cases represent less than 0.2% of the economic activity happening on Bitcoin. Last year, Bitcoin settled more than $1 trillion. This is really impressive. And we can track that on the blockchain. And this is what these firms like Chainalysis and Elliptic do an amazing job to provide the results and the data for the entire community and the regulators. And they work hand in hand with enforcement and agencies as well. I
know a guy at Elliptic who was telling me the FBI love them because it's so much easier tracking criminals than it is any other way. And another statistic I heard was, as you say, it's sort of 0.2% of all Bitcoin transactions are nefarious. It's something like in the real world, it's something between 2 and 3% of all fiat transactions are nefarious. So there we go. Yeah, it's certainly not the central use case, and anyone who's tried has normally come pretty badly unstuck. How can it be a store of value, Ellie, when it's so volatile and it's so difficult to understand what its intrinsic worth is? It doesn't have a yield. It doesn't have earnings. Right. How do we come to some sort of idea about what it's worth?
This is really fascinating because a lot of people and investors are asking us, what is the intrinsic value of Bitcoin? How do you value that? And the best analogy of Bitcoin, again, is that this is an emerging store of value, and the best commodity today to compare it to is gold. But gold has the benefit of time. It is the most liquid commodity out there compared to Bitcoin. It has more than $11 trillion in value. And because Bitcoin is less than that, but Bitcoin has superior properties compared to gold. It's a lot easier to transfer. It's a lot easier to be accessible. It's easier to store. It's more convenient. And it's more accessible in a way that you can divide Bitcoin by 100 million coins. So this is accessible with a few cents. However, Bitcoin is volatile because it went from 0 to close to $1 trillion in value. But at the same time, looking at the macro environments and the rise of geopolitical conflicts, the most important value proposition of Bitcoin is censorship resistance. And the fact that censorship resistance in the rise of geopolitical conflicts and the fall of civil liberties and freedom, as measured by the Freedom House, we can see that there is a strong investment case for an asset like Bitcoin, and not just as a digital commodity in a world where actually we see higher inflation levels, not just driven by money printing, but also supply chain shocks because of what's happening in the war between Ukraine and Russia. We see that Bitcoin could become a store of value, but it would take time. It would take a lot more liquidity and adoption across the board. That would require more institutional grade products to be available for retail investors, but it would also require a better infrastructure for the people in need to have access to better internet and electricity in order to actually use Bitcoin. And most importantly, again, education is key. Transparent education about the risks and the reward of that potential investment and use case is to the utmost important, and not just in English, but also in other languages. And that's why 21Shares, we push for Italian, German, and French, and soon Spanish, because education is very important so that people can understand this asset class a lot better and navigate with their local context.
Yeah, I think that's super important. I know you guys do a great job of that. And actually that brings me on to another a really important point, I think, which is the sort of discriminating between Bitcoin and other crypto. I think they are in different risk baskets. I think they're very different types of investment, because a lot of people go, they just think of all crypto as all crypto. Bitcoin's just part of all crypto. You're in all crypto, you buy all crypto, you sell. Do you know what I mean? without, and it's an incredibly important distinction, I think, that Bitcoin has evolved as a serious investment asset. And you can see that by the way it trades, the volume it trades, the size of it, the volatility even is structurally coming down. And as you've mentioned before, you've got serious institutions around the world and investment banks throwing resources at it. So could you just sort of expand on why it's different from the rest of crypto?
Yeah, totally. And I think cryptocurrencies or cryptocurrency in general is a misnomer for this asset class. And what we've seen from 2010 to 2015 is that there were a lot of coins or cryptocurrencies trying to replicate Bitcoin, but with better features. We've seen with Litecoin, we've seen with Zcash. Some of them were faster, more private, more accessible, or less decentralized or more centralized. But none of them were able to replicate the network effects and the strength in the developer community, and obviously the adoption of the vendors around it to provide the liquidity compared to what we've seen for any other copycats of Bitcoin. And that's very important because at the end of the day, there is a lot more use cases that use blockchain technology for building the next generation of the App Store, like, for example, Ethereum, that is completely different from Bitcoin. Yes, there is a crypto assets to align the incentives around these stakeholders, but the fundamental use case is completely different from what we've seen with Bitcoin. But again, the thing that they have in common is that crypto networks or software, and that means that they were flexible and that they could expand their use cases. We see that with, for example, the Lightning Network built on top of Bitcoin to provide faster, payments on top of Bitcoin. We see that as well with Stacks trying to provide applications on top of Bitcoin, very similar to what we see with Ethereum, with the metaverse and NFTs and decentralized finance. But however, today, we know that the main use case that has received a strong stamp of approval has been an emerging store of value for Bitcoin compared to anything else. And that's a very important, I think, aspect to take into consideration, because there is no such things as Bitcoin today, especially when people think about specific use cases of Bitcoin in different contexts, whether it's investing in a digital native commodity or investing in a censorship resistant payment network. Usually the first thing in mind is Bitcoin. So Bitcoin has become a consumer brand that is recognizable around the world. Despite the reputation historically, we know now with data that this is not drug money and that this commodity actually is used by serious investors. And people understand, especially, a lot of participants like banks understand that this is here to stay, and that's why many of them want to become custodians. We've seen that with BNY Mellon. We've seen that with a lot more institutions trying to not just invest but participate in investing in the mining industry, investing in the custody of this asset class, and that's really fascinating.
Yeah. Well, that's a good point to kind of talk about. We've talked about what it is. I hope people have got a really great idea about, why it's here to stay, why it's safe, and all its rather remarkable properties. But what about the future? How do we think about that? You've mentioned, it is a technology at heart. It is a technology, and technologies evolve. Do we know do you have thoughts about how adoption will evolve, and what are the barriers to adoption at this point? And is there any evidence that adoption is anyway sort of slowing down or stagnating at this point? What are your thoughts on how it moves from here?
This is really fascinating because the adoption of Bitcoin would be dependent to some extent of the regulatory landscape.
Yeah.
Whether for example, in a country like China, Bitcoin could become a niche commodity or a niche investment for many people using VPNs or having access to, for example, offshore bank accounts or wallets to invest in this asset class. And I think an embracing regulatory environment would be beneficial for more investors to be confident about this asset class, to take this asset class more seriously, and to have access to obviously documentations and materials to learn more about it. And the other thing that I would talk about is how the companies building on top of Bitcoin, whether these are like derivative exchanges, could become more regulated as well, because the derivative markets is the largest segment in crypto, a lot more larger than what we see with the spot market. And making sure that the derivative markets gets more regulated over time, not just through the SME in the US, but also over venues like that use Bitcoin futures, would be also another important topic to keep on the lookout, to make sure that this gets more regulated and accepted over time. Because at the end of the day, when we see large corrections as we've seen over the past 3 weeks, there is a lot of escalation in the derivative markets through liquidations. And some of these venues provide sometimes 10 to 20x the price of BTC in the futures market. And this needs to be obviously regulated and I think more closely looked into. And that's why we've seen, for example, Binance and FTX phasing down the leverage ratio in Europe as well, down to 5, for example, 5x compared to 20 historically. So that's for the vendors built on top of Bitcoin, to make sure that they have a regulatory landscape that is clear enough to navigate in each jurisdiction. And then the second thing is to make sure that the Bitcoin network keeps on innovating and keeps on attracting developers to fix the vulnerabilities. And that would be very important as well, because it's a software at heart, right? And we need to make sure that the bugs and the vulnerabilities are solved promptly. As we've seen, for example, in 2018, there was a bug in the Bitcoin network that could have enabled miners to mine a lot more Bitcoins that they were supposed to receive. And obviously that could have destroyed the value proposition of Bitcoin of 21 million coins limited by 2140. And I think like having a strong community of cryptographers and developers to make sure that Bitcoin stays relevant in a moving world, it would be also very important. Whether Bitcoin could become more secure with the threat of quantum computing, right? So that requires developers to make sure that they stay in touch with the reality of the quantum computing threats, would be as well important from a developer adoption. And then the last thing that I would say is that education is key. And we have, I think, barely scratched the surface to make Bitcoin more accessible, because people try to use, for example, non-custodial wallets in emerging nations, but they need to remember 24 words in order to make sure that they can retrieve the coins if they lose their, kind of like vaults, digital vaults. And I think like having a better user experience when interacting with things that are not available on stock exchanges, like the non-custodial wallets, would be also very important to adopt this asset class a lot more. And that's why today, we have a very limited adoption, but a faster rate than the late 1990s of the internet. Today, close to 200 million people have had access to this asset class. And this is exactly what happened in the late 1990s, where only 5% of the world population had access to the internet. And today, only 5% of the internet population has access to crypto. So we have a lot more to do, right? This is still early stage.
Yeah. I think that's absolutely fascinating. I didn't realize that 5% figure. It's huge. And I kind of wonder whether there's a kind of a sort of transitional stage between the early growth investors for whom volatility was the reason to be invested in Bitcoin, and the next generation who were put off by the volatility, but kind of understand the core use case, particularly in a sort of very inflationary world. And as the volatility reduces, we'll see a switch in ownership to much more institutionalized base. And of course, that'll give people who are genuinely wanting to use it as a form of money much better grounds for doing so over time. So it's kind of volatility is its friend and its enemy all at the same time. And of course, you've got a younger generation. So amongst my kids, my children's friends, they're all fascinated and buying little bits. A good question here. Gold has a history of confiscation. What are your thoughts on Bitcoin? Can that be done?
That's really interesting because we exactly discussed about that as recently as like a few days ago at 21Shares. Because in the late 1930s, the US government decided to actually seize the gold to make sure that the US dollar is properly backed by gold. And what we see here is that the pseudonymity, the fact that Bitcoin is pseudonymous and not anonymous, means that if a government tries to confiscate Bitcoins, they will have the possibility to move the coins away to another wallet or to another wallet that is accessible in another jurisdiction. So there is absolutely a possibility. This is a risk. And I think this is very important to lay down the potential risk around Bitcoin, whether it's quantum computing, whether it's like a regulatory clampdown, and confiscation could happen. We've never seen that. But in the case that this happens, it would be a lot more difficult for the government to clamp down on the micro levels, so on the individuals to confiscate the Bitcoins. They would have basically the possibility, unless the government decides to shut down the internet, they would have the possibility to move the coins away to any other regulatory friendly jurisdiction. But that's absolutely a possibility. But based upon what we see right now, it would be a lot difficult for the government to do so. And that would basically require a coordinated attack on the individuals through the vendors. So through exchanges, through wallet providers, and other service providers as well.
Yeah. So extraordinarily difficult. We're sort of coming up to the hour mark. If people do want to ask questions, fire them in now. What else did I want to ask you? I was going to ask you if about the recent episode with Terra and stable coins and how this affects the ecosystem as a whole. What are your thoughts on that? Because people might know there was a collapse of what's called a stable coin.
Yep.
The other day. It was algorithmically backed, which looked sort of concerning to anyone who looked any closely at it. But it wiped out a huge amount of value, and of course made the headlines like these things always do. Do you think that's seriously bad news for the crypto ecosystem, or just another learning point along the road?
I think it's a blast from the past because we've seen in history in the crypto market that uncollateralized and algorithmic stablecoins failed to gain substantial adoption and failed to obviously maintain the peg. We've seen that with Basis Cash, with anti-dollar, anti-set dollar as well. These are counterparts of Terra that failed in the past. And the fact that the crypto industry now has gained a lot of adoption, but also market value, people understand that this asset class needs to be segmented. And we cannot compare uncollateralized stablecoins to fully collateralized stablecoins, like, for example, USDC compared to UST from Terra. And then let alone trying to compare Bitcoin with what happened to the Terra ecosystem. Because the crypto industry is very similar to the software as a service industry. And we have so many emerging sectors and use cases that are completely unrelated to what Bitcoin attempts to do or what Ethereum attempts to do. And that's why what happened to the Terra ecosystem and the stablecoin is honestly a very unfortunate event, because many people lost their life savings. Many people lost a substantial amount of money. But most importantly, what we see is that there is a strong community around it to make sure that people get supported and can retrieve some of their lost funds through donations or even like peer-to-peer engagements. But most importantly, I think the big lesson here is that the crypto industry will keep innovating, but most importantly, as an industry, we need to do better to expose and disclose the risks around some of these crypto assets. The risk-reward ratio, again, is not the same for emerging and experimental crypto networks. And I think that's really an important exercise to do by all of these foundations and companies or projects behind these experimental protocols.
Yeah, I think that's an extremely good point. Question here: Bitcoin is based or comes out of a code that's yet to be broken, but with the advance of computers, particularly quantum computers, can the code remain unbreakable? Is it at some stage doomed to technical advances? Some massive computer will one day come along and obliterate it. Is that a possibility?
And to be honest, it's a possibility. But again, the level of the probability is very important to take into consideration. Quantum computing is where Bitcoin was back in 2008. So this is very early stage to basically threaten the security of Bitcoin. But again, I want to talk about more technically here, what would be the threat of quantum computing on Bitcoin? So Bitcoin uses a special algorithm to secure the network, and it's called SHA-256, secure hash algorithm. And the secure hash algorithm, that specific number, is used for securing our internet connections. So if you go on your web browser and you visit your settings, you would see that your internet connection is secured by SHA-256. So if quantum computing is able to essentially reverse engineer the security of Bitcoin, that would be the same to our internet connection. And that's why, again, as I mentioned previously, the traction of the developers and cryptographers to work on the latest quantum resistant algorithm would be as well very important. And we see that as well in many other blockchain projects and networks, like, for example, Ethereum. They have on their roadmap specifically written and a lot of R&D investments on quantum resistant algorithm. And we see that as well with zero knowledge proofs. So all of these scaling solutions to make sure that blockchains can scale to millions of transactions per second, they are focusing on quantum resistant algorithm as well. And the Bitcoin community would need to focus on that too. And we know that it has been in discussion over the past, even like since the genesis of Bitcoin, even during the forum where Satoshi Nakamoto was discussing about the threat of quantum computing. But that's a possibility. And again, it would be mitigated by how responsible and how quickly the developers can give a quick turnaround to this threat.
And you've got to ask as well, haven't you, what the point would be of destroying Bitcoin? But am I right in thinking that any super quantum computer would have to get a 51% control first, and at that point you can you own it and can destroy it? And to do that, the amount of energy used would be simply astonishing. And then the value of the network would go to zero. So it's not a particularly constructive use of computer time, but we never know, I suppose, what people choose to do these days. But it's a fair question, because it's a
fair question, yeah. And to give you a number, actually, today to have 51% of the computing power of Bitcoin, it would cost an attacker close to $1.2 billion to just have 51% of the computing power and being able to reverse the set of transactions within an hour, just an hour. So imagine the cost that we would get, that would require for 24 hours, or even like for the entirety of the lifespan of Bitcoin. And it's very costly. When you look at the GDP of some emerging nations or, authoritarian governments, this is like, close to a few percentages of their GDP, and they have no incentive to use their government spending on that.
Are there any more questions? I don't think there are. And we've come to, we're 5 minutes over the hour. I hope in this short amount of time that people will have got a much better idea of what Bitcoin is, how it's evolved, the sort of role it can play in the future, some of the threats, some of the worries that we have. Huge thanks to you, Eli, for helping us sort of explain all this. And I hope people can look at this and take some time to go and explore more into this new world. Thank you so much for joining us. Do look up 21Shares; they're fantastic. They've got a whole swathe of great products over in Europe, and fantastic research. And Eli, thank you so much once again. Maybe if there's demand, we'll go on and do something like Ethereum in another episode one day.
Sounds good. Thank you, Charlie. It's been an honor. Thank you so much, guys, for listening in. And obviously, if you have any questions, feel free to reach out to us at 21Shares. But thank you so much for having me. It's a pleasure.
Great stuff. Bye, everyone.
Thank you. Bye, everyone.